Okay, excuse me, that got cut off a little bit. On this computer, there's an hour time limit, and we've hit that, so we're back to this. Cash credit, because cash is always decreasing in a cash payments journal. And just a reminder here, all outflows of cash get recorded in the cash payments journal. Cash is always decreasing, that's why credited. Okay? And now you're going to have a purchase discount column. Purchase discount as a credit, or, and I emphasize or. So here's an asterisk, asterisk, or. Okay? Or call it inventory credit. And this will depend on if you're using a periodic or a perpetual system. If you're using a periodic system, you call it purchase discounts, because in a periodic system you are not continuously updating inventory. But if you're using the perpetual system, you will put inventory here. So this is not one of those column headings that has two simultaneous accounts being affected by the entry. This is not one of those examples. This is saying it can be either purchase discounts credit or inventory credit, depending on the type of inventory system you are using to manage. And if you need a refresh on that, watch the periodic perpetual videos on inventory systems. But that's what this means. Okay? Now, accounts payable, debit, because cash disbursements, another way that cash will be leaving our business is by us paying off the accounts payable that we owe. So accounts payable would be debited, since it would be decreasing in that case. We could be making a direct cash purchase. Okay, so inventory here would be debited. Okay. A second way that we would be using cash is by buying inventory with it. Therefore, inventory debited. Again, inventory is purchased by us with intentions to sell it, not to use it. That's what inventory is for. Okay, then you're going to have sundry. Remember, sundry will specify any other reason that we're using the cash that's not listed in these columns already. Okay, PR for when we update that particular ledger. Whichever vendor we are paying off, when we update their ledger, we can check it off here in the post-reference column. Okay? And then sundry amount. I'll put sundry $sign. That will be a debit as well. So we'll explain it as we go. Remember the three reasons? We're either paying off an expense, paying off some kind of, or purchasing some kind of inventory with cash, maybe purchasing an asset with cash. If it's an asset, we'll specify it in the sundry account column. And then the third way that we're using it is by paying off an accounts payable. Let's say on March 1st, we're paying off an accounts payable. Any of the reasons why you're using cash, by the way, you're always going to write a check. So it doesn't matter the reason. Check will always be written. Check number 101. Cash will always be credited in this journal because we're using it. It will always decrease. How much are we paying off on that vendor? Who did we pay? Sam? Sam, we bought $250 worth. We're paying that $250 off. So cash, but let's say that we made a discount. Since we are paying it off in the discount period, and don't worry about the dates if they don't match the purchase discounts. Yes, I do emphasize that dates are important, and they are in real practical life. But for the purposes of this video, this demonstration, don't get so caught up with that. You get the point though, right? When you buy something and you are entitled to a purchase discount for it, it will be granted to you if you pay within that discount period that's specified in the terms, okay? So let's pretend that March 1st is within the discount period, and we're paying off that $250, but we're getting a 2% discount off the $250 because we're paying within that discount period. In a periodic system, again, we would be crediting purchase discounts. In a perpetual system, we're crediting inventory, okay? So what do we say, 2% of 250, what is that? $5? Is that $5? I think so. $5, which means that $250 that we owe Sam, remember the credit purchase we made from him? Well, now we owe him only $245. That's why our cash, actually and factually, is decreasing by only $245. You see? The other credit here, either for inventory or purchase discount, will be for $5. And then the debit will be accounts payable for the full $250. Accounts payable debit. And then we know that this is just a general accounts payable account. We need to specify the exact customer. Where are we doing that? In the column where we specify and provide more detail, which is called the sundry account column. Accounts payable, Sammy. Okay? Go to Sam's accounts payable, debit it for $250, which will now in effect bring that account to zero. We don't owe him anything else anymore, as of now at least. As soon as you've done that, come back to the cash disbursements journal and check off the post-reference column. Okay? Okay, now let's say we're making a purchase of inventory. We're not paying off an accounts payable now. On March 3rd, again, any use of cash means we have to write a check, 102. We're using cash by buying inventory for it. How much inventory are we buying? $100 worth. Cash is always used in this journal, just like it's always used in the cash receipts journal. No purchase discount or inventory to credit here because it's not an accounts payable being paid off. So this is blank. Accounts payable, again blank, not being paid off. Inventory, we're purchasing $100 worth. There. Again, why are we using this journal? Why are we using this journal instead of the purchases journal? Because we're buying it directly with cash here. In the purchases journal, we were buying our inventory on credit. Okay? If you buy it directly with cash, that's one outflow of cash example, and that's why we're demonstrating it here. Okay? Since we bought inventory, we can just leave it. We don't have to specify. Inventory has been specified here. Okay? No subsidiary account to update, so therefore no need to check off the post-reference column. We can maybe give the account number for inventory. Let's say it is an asset, so it's still in the 100s. You could say 108 if you want. It doesn't, it's not that important. If you need it, put it, but since the account has already been journalized here, you already know what happened. You bought inventory. Okay? No need to check off, no amount to put here. Now let's do that third example where you're buying something else. You're not buying inventory, but you're buying another piece of equipment. On March 4th, using check number 103, cash, you're buying $150 worth of machinery. No purchase discount or inventory credit here because no accounts payable is being paid off. So that discount of 2% or 3% or whatever it is does not need to be applied here. Accounts payable is not being paid off, leave it blank. Inventory is not being purchased here, leave it blank. Again, we're buying, let's say machinery. That's what we will specify here in the sundry account. Machinery, okay? Post reference, you can specify the machinery account number. It's a capital asset, so it'll be a little bit higher. Let's say 111. And how much are we purchasing the machinery by? We will put in this final column since it has not been recorded in any of these preceding columns. So that 150 will just be here. Notice it's a debit here to match the credit for cash here. You see? Okay, so of course you will get the totals at the end of the month. You have March 31st over here. You'll do the totals of cash. 345, 495. Okay, total here 5, 250. Inventory 100. Sundry account 150. Okay, and you know that the subsidiary account for Sam was updated right away on March 1st, but now you can go to that accounts payable controlling account and put that full 250 there since it was only the one sale, right? It's likely that we will have more suppliers and vendors we're dealing with here, so this amount will be different than any one accounts payable subsidiary account. But in this case, since we only made that one payoff of one of our vendors, then that's why it's matching here. The 250 is matching what equates to just Sam's accounts payable. So end of the month, total accounts payable, controlling account. End of the month, the cash total. End of the month, the purchase discount credit or the inventory credit, depending on periodic or perpetual system that you're using. End of the month, inventory will be debited in the inventory ledger for 100. Make sure it has that March 31st date, end of the month. And then 150, end of the month, you say sundry account, you say, well, what sundry account? You want more detail, you want more explanation, go to the sundry account column to find out which account that belongs to. So machinery will be updated for the 150, since machinery is the only sundry amount to post at the end of the month. Now we talk about purchase returns and allowances, which is the opposite of sales returns and allowances. Since purchase returns and allowances does not have a designated column here, such as purchase discounts in a periodic system, the purchase returns and allowances also get recorded in that general journal, just like sales returns and allowances do. Except we are communicating that purchase return and allowance to our vendor through a debit memo. A debit memo this time because accounts payable is being debited. You see? The sales returns and allowance is called a credit memo because accounts receivable is being credited by being paid off to us. A purchase returns and allowance is called a debit memo because we are paying it off, meaning accounts payable is decreasing. Okay? Called a debit memo. And by the way, we are preparing the credit memo and sending it to our customer in a sales return and allowance context. And we are also preparing the purchase or the debit memo in a purchase return and allowance when a customer returns to us. Right? Because it's all through the eyes of our company. We are preparing everything because we want records of everything. We want all the debit memos, all the credit memos, so we can always cross-reference and verify why account balances are the way they are. And then you'll prepare that purchase returns and allowance entry in the general journal by debiting accounts payable connected to that vendor. Okay, means we have returned something to the vendor. We're going to prepare the purchase, the debit memo. Debit accounts payable to, let's return it to George. All right. Reason we didn't pay off George here is because we returned his stuff. There we go. We're reconciling everything we talked about here. Debit George's accounts payable subsidiary ledger because accounts payable is decreasing since we're no longer paying it off. And then credit purchase returns and allowances because purchase returns and allowances is a natural credit balance since it is a contra expense account. Okay? And then the explanation on the third line in the general journal will be Debit Memo 101. That's in a periodic system, how you would record that. In a perpetual system, you will just directly credit inventory instead of crediting purchase returns and allowances. That's the only difference. Okay? And also, going back to the sales returns and allowances, I don't recall if we mentioned, but sales returns and allowance was the debit in the general journal entry, since it's a contra revenue. Accounts receivable, the credit connected to that customer that has returned it to us. Credit because they no longer need to pay us, and therefore accounts receivable is decreasing. And then in a perpetual system, you have to also do that second entry to record the cost of goods sold and the inventory that has been returned to us. Okay? Only in the sales world. By debiting inventory, since that customer returned it back to us, so inventory is now, we're putting it back into inventory. Inventory debit, cost of goods sold credit, since we can no longer consider the amount that was returned to us a sold portion of our inventory. You see? So that's the sales. In the purchases, you're doing one entry in the periodic system, debiting accounts payable to that vendor, crediting purchase returns and allowances. In a perpetual system, also debiting the accounts payable to that vendor, but crediting inventory instead because we want a direct account of what is happening in inventory after each purchase, after each sale, after each sales return and allowance, after each purchase return and allowance. Okay? So there you go. So the general journal is still relevant, it's still useful to us, but now we see that it only needs to record just the debit and credit memos, as well as all of the adjustments that we learned in step 4 of the accounting cycle. Okay? All other type of entries can be recorded in all of these special journals, and make sure you know how to record them. Again, you're not going to need to know how to set up the structure of any of the journals. They will be provided for you already. If you have access to or if you've accessed the resources on the textbook website, then you already have the templates available to you that you can just fill in. Okay? And then finally, as a part of this purchases conversation, we're talking about the schedule of accounts payable now, which is the opposite of that schedule of accounts receivable. And the schedule of accounts payable is recording everything that we still have to pay off with respect to our credit purchases. So how much do we still owe Sam? In this case, nothing, because we paid him off. But if that nothing has not been recorded yet, we will record it for the first time in that schedule of accounts payable when it is requested. And then just update how much George still owes, or how much we still owe George, and how much we still owe Stacy. And if we have other customers, other vendors or suppliers that we're dealing with, we will specify how much we owe each of them, and then get a total of schedule of accounts payable. And there you have it. Okay, special journals. Again, rewind if needed. Discussion boards are always available. Let me know if you need any help with any other questions. And another reminder that this video does go along with that periodic and perpetual discussion. Okay, since we are making purchases of inventory, therefore ultimately selling that inventory. Whenever you purchase and you sell, you are dealing with inventory. And therefore you're dealing with a certain type of system with that inventory. And that's why periodic and perpetual goes with purchases and sales. You see? All right. This was a good one. Until the next one.